Good morning and welcome to the SERINUS Energy PLC Q1 2024 financial results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Jeffrey Auld. Good morning to you.
Good morning, thank you. Welcome everyone to the SERINUS Energy PLC financial results for the 3 months ended the 31st of March 2024 investor presentation. I'm joined today by Vlad Ryabov, our CFO, Stuart Morrison, our Chief Operating Officer, and Kelvin Brackman, our VP of External Relations and Strategy. Just a quick overview of the business. As everyone knows, we have a large concession in northwestern Romania of 3,000 square kilometers. This has our Moftino gas plant on it. The replacement cost for the gas plant is $15 million. That gas plant is a skid-mounted gas plant, so it's movable to any new fields we are able to find. This is a very prospective block. There's been lots of work done on it, and we think there's lots of new gas prospects that we can pursue. In Tunisia, we have 2 production concessions: the Sabria concession, which is a large 445 million barrel oil in place field, with only about 1.6% of that produced to date. So a field that could use a lot of work on it to increase that production and get that up to sort of more normal recovery rates. The Shueisha side of the field is in the south. This is where we've managed to install gas lift or artificial lift and managed to increase the production there over time. Underneath the oil prospects are large gas exploration prospects. Those are the same prospects that Nawara, the big gas pipeline in the OMV system, produces from just to the east of us. So it's a very interesting gas exploration play with oil on top of it that we're currently producing by means of artificial lift. That artificial lift sort of demonstrates the potential that we could do in Sabria if we can get artificial lift in there. So there's lots of investment opportunities from our existing assets. Post the period end, after our oil lifting happened just after the period end. We lifted 62,930 barrels. We received $3.2 million in cash for that. That's net of a couple of prepayments that we had to smooth out our cash flow. We expect 2 more liftings in 2024, and we've confirmed the next lifting to occur in August. The company remains debt-free, and our capital investments are funded from our operating cash flow. So we accrue the cash flow, we buy the long lead items, we invest that in the projects we have. Quite clearly, when we have a 445 million barrel oil in place field with 1.6% produced, that's the Sabria field, we'd very much like to accelerate that capital, but we're currently running with our capital investments from free cash flow, and we intend to do that. Every year we have third-party reserve engineers report on our reserves. Our company is currently trading at a value of 66 cents a barrel of oil as per those third-party independent reserve engineers. And that's against a sector average of $8.36. And that tells us a couple of things. Firstly, it tells us that the company is very cheap. And it tells us that capital invested in this field can move that valuation from 66 cents a barrel of oil equivalent to more closely to that sector average. The reserve life of that field at current production is almost 26 years. We strongly control our corporate costs. We are working onshore, so the operating costs are relatively low. We have good fiscal terms, although those have deteriorated in Romania. And the onshore position and our access to infrastructure or loading points gives us strong commodity pricing. This is just a quick overview of both of the areas. I think I've covered this in the first slide. It gives you a little map of where our assets are. It gives the proved and probable reserves. Again, these are prepared by third-party engineers. You can see the resources, the 2C resources, Romania 2P resources, so the more exploration-based, we estimate to be about 188 million barrels of oil and gas. We have established teams in both countries. Romania is run by Romanians and Tunisia is run by Tunisians. We have very competent and trusted locals that are running our business. So we don't have the G&A of expats. We don't have the friction that sometimes expats can incur. And in both countries, our operating teams have excellent relationships with the regulators and the authorities that regulate our businesses. Operational highlights. Stuart, I'll hand this over to you if you want to run through it quickly.
Yeah, certainly, Jeff. So production's largely flat from the previous period, with the natural decline in Moftinu in Romania offset by increase in production in Tunisia. The increase in production in Tunisia has been really largely due to the team's management of those artificial lift systems, which are submersible pumps. And the run life that they're managing to get out of those has been improving year on year. So we now have one pump is approaching 3 years. So good job done by the guys in the field there. The Sabria West 1 sidetrack, the design's been completed on it. Procurement is well underway. And when that comes on stream, we expect a material increase in our net production from Tunisia. Sabria N2, it's not dewatering fast enough. We need to improve the productivity of that well. And we are still in discussions with our partner ETAP, the state company, regarding how we manage to get that done. In Romania, we have got our exploration area extension. We got that in Q4, which is the area outside of the declared commercial area of the gas field. We have 2 phases to the extension. The first in the medium term relates to some seismic, and the longer term we have a well commitment, although we don't have a commitment to the debt requirement there at all. In Moftinu, as I mentioned, we're continuing the natural decline that you'd expect from a shallow gas field, although we have looked at all the opportunities, and there are some gas zones in the current well stock that we can go after. So there might be some opportunity there to keep that field going. The water injection well is performing really well. All the produced water from Moftinu is injected into that well, and it's delivering quite substantial cost savings on the operating expenditure.
Vlad, I'll hand it over to you to go through the financial highlights.
Sure, Jeffrey. On the financial highlights and performance, revenue for the first quarter of 2024 amounted to $4.6 million, reflecting a slight decrease from $4.9 million in the first quarter of 2023. The revenue was derived from the production of 234,000 barrels of oil equivalent across operating assets in Tunisia and Romania. Tunisian revenue increased if we look at the breakdown of the revenue across the business units, and Romanian revenue decreased compared to the previous year's quarter. The gross profit for the same period of 2024 was $1 million, showing an improvement from $0.9 million in the first quarter of 2023. EBITDA for the first quarter of 2024 stood at $0.9 million compared to $0.8 million in the previous year's first quarter. Funds generated from operations in Q1 2024 amounted to $1.2 million, marking a significant turnaround from the funds used in the operations of $0.8 million in the first quarter of 2023. Our G&A, general and admin expenses in Q1 2024 decreased to 0.9 million or $15.75 per barrel of oil equivalent, down from 1.4 million or $22.01 per barrel of oil equivalent in the same period of last year. The net loss for the 3 months ended in March 2024 was $500,000, a significant improvement from the net loss of 1.3 million in the same period of last year in 2023. So overall, while there was a slight decline in revenue, the group demonstrated improved gross profit, EBITDA, and funds from generated from operations. That reflects on the cost management efforts, which are evident through the reduction in the corporate G&A and keeping our production expenses under tight control in all of the operating business units in Tunisia and Romania, regardless of high inflationary environments, which we all experience throughout the board. The company realized price of $80.24 per barrel of oil equivalent for the first quarter of 2024 compared to $75.87 per barrel of oil equivalent in Q1 2023. The comprised realized oil price of $84.24 per barrel of oil equivalent per barrel of oil in first quarter of 2024, which was up from $80.07 per barrel in the first quarter of previous year, and a realized natural gas price of $10.99 per MCF, which is down from $12.72 of MCF in the same period of last year. The group's operating netback for the first quarter of 2024 was $33.04 per barrel of oil equivalent. While the company saw an improvement in the realized oil prices, the netback per barrel of oil equivalent decreased due to lower realized natural gas prices and declining production in Romania, while the netback in Tunisia remained very stable. Despite these challenges, the positive operating netback in Tunisia partially offset the overall decrease. The company continues focusing on optimizing operations and managing costs effectively throughout the board in all operating units and at the corporate level to enhance profitability and financial resilience.
I just comment on the cash balance here. The cash balance at the end of the period was $600,000, but you have to remember that less than 2 weeks later we had our lifting. So unfortunately, we don't time our liftings to be able to have our cash numbers spike up for our quarterly reports. But the lifting came in just under 2 weeks after the end of the period, which, you know, we do have spiky cash flow because of the liftings and the timings of the liftings. So I wouldn't want anyone to take alarm. That's that's sort of the lowest we could ever get just before a lifting, and we do very, very carefully manage the cash flow. So that, you know, we are spending what we need to spend, but we're managing it such that we're not drawing it too tight right before the liftings.
Thank you, Jeff. This slide shows the graphics of the revenue, cost of sales, and gross profit and net income for the first quarter of 2024 in comparison to the first quarter of 2023. And I think it's pretty much covered in the previous slides already, so we'll not stop on this one. The average group's production volumes for the first quarter of 2024 was 635 barrels of oil equivalent per day, totaling to 234,000 barrels of oil equivalent for the whole period. And that is what reflects on the monetary equivalent of our revenue. Tunisia saw an increase in production, approximately of 11% compared to the previous year's quarter, attributed to a workover program and reservoir management initiatives. Romania experienced a production decrease primarily due to the natural declines, which Stuart already covered on the previous slides. The group's average realized price for the Q1 of 2024 stood at $80.24 per barrel of oil equivalent. This reflects a higher realized oil price, which more than offset lower gas prices in Romania. While Romania faced production challenges due to the natural declines, which we discussed during the previous slides, Tunisia's production increased due to targeted operational initiatives. The group's average realized price benefited from higher oil prices, mitigating the impact of lower gas prices in Romania. The production expenses at the group level did increase, and but again, they remained pretty much under the below the inflation rates in Romania and Tunisia. The operating netback for Q1 2024 stood at $33.04 per barrel of oil equivalent. This figure reflects the impact of lower gas prices and production volumes in Romania compared to the comparative period. However, it was offset by the higher oil prices and production volumes in Romania, with an average realized price of $80.24. So all in all, we've got the operating netback in Tunisia of $40.16 per barrel of oil equivalent, and Romania reported a negative netback of $55.76.
I would say on the production expense, it is, we are still in an inflationary environment, certainly for oil field services. We would always like to see that production expenses stay flat or be able to eke out improvements in it. But in the face of the inflation levels that we've seen, we've tried very, very hard to keep that as low as possible. And it's well below the percentage of inflation that we would see across the board. So buried in the number that does go up, we have the fact that it's fighting against a very harsh inflationary environment.
So the capital expenditure was solely incurred in Tunisia in our preparation for the capital expenditure programs, and that is the acquisition of the long lead items, inventory items, and equipment items, which we will require later in the year for our planned capital program in Tunisia. Funds from operation. Despite the mixed performance across the operating segments with the positive contributions from Tunisia, but negative netbacks in Romania and reduced corporate costs, the group managed to generate positive funds from operation of 1.2 million. And that is a significant improvement from the same period of last year. The improvement in EBITDA indicates overall operational stability and efficiency, which we are trying to get the group to.
Good. Thanks, Vlad. We're always very proud of our environmental and safety record. Cal, do you want to just quickly run through this?
Yeah, sure. Yeah. The company continues to apply the highest standards of environmental and safety management, and we conduct strict environmental monitoring and mitigation at all our facilities in Tunisia and Romania. As for the safety of our employees is paramount to the company. We've had no lost time incidents in the past quarter, and this reflects the tremendous dedication of all of our employees ensuring a safe operating environment.
I could say we're very proud of this, but we're also very focused on this. We do work in an industrial environment, and we have very serious training exercises and drills. And I think it's important to note that since the initiation of production at Moftino, we've had no lost time incidents, and we're closing in on we're exceeding 3,080 days in Tunisia. So we are very proud of that, and we work very hard on this. So in summary, the company is stable, cash flow generation is stable. We are working on cost control as best we can. We have been surprised by the fundamentals in the oil market. We've seen tensions in the Middle East. We've seen continued war in Ukraine. And we haven't seen the fundamental crude market spike up like I think we would all like to see it. But we're quite comfortable at the oil prices that we're currently selling our crude at. We'd always like to see higher, but we're stable and in good position at these prices. The production funds the core business and it funds our future developments. There's two good things about that. The first good thing is that we don't come back to shareholders and repeatedly dilute them to do our operations. We run our operations with the cash flow that we generate. The frustrating thing with that is it's not as fast as we would like to move. We would love to have capital to apply to both exploration in Romania and get some of these programs in Tunisia accelerated. But the flip side of that coin is we're not going to expose people to massive dilution to do that. I think we've gone through the capital plans, the N2 well. We really want to get that dewatered. There's a difference of opinion on how we do that with our partner. We think solvent and acid in the well would be commonly used, and we're very much trying to convince them to do that. We very much believe this well acts like other wells adjacent to it, that if we are able to dewater it, this can be a good producer. That was a good workover. It did exactly what it removed all the old bits from the well, and now we're just left with the dewatering. So it's still a valid well. We would like ETAP to move faster, but with any partner, they have their capital constraints, and getting the two capital programs to coincide is always a challenge. The W1 well, the sidetrack design is done, and as Stuart said, the long lead items are well commenced and well on their way. We are working with the rig company in Tunisia to get a rig slot. Of course, this depends on people ahead of us who are using the rig, how long their programs take. If their programs are quick, then we'll get it faster. If their programs are slower, then it'll be slower. At this point, we've guided towards the end of this year that we don't have a contract in place yet to give us an exact date because it's dependent on what happens with others. But we have managed to extend the contract terms for a year, so we're locked in another year on the same contract terms. So that's good. We would very much like to get the pump in Win 12. Win 12 is our best producer. The third-party engineering reports on what artificial lift could do to that well are very impressive. And we'd very much like to get going on that. Our partner requires us to have an active artificial pump in a well demonstrating that it works before we go into the best producer. So there's caution from their point. We would probably just want to get right in there. We trust in the artificial lift program. We see what it's done in Shuesh. But again, we have a partner in that field, and the partner, they have their own capital programs and desires. We completed our block-wide geological geophysical study in the company at the end of last year. We're looking now devising the 2D seismic program to target the best prospects. There are some very nice prospects that we've identified, and that longer-term exploration opportunity really is some blue sky exploration. It's not insignificant volumes, like I said, 180-ish million of prospective resource sitting out there that is onshore and relatively cheap to develop. And as people should know, there's infrastructure all across Romania that's easy to tie into and get either crude or gas to market very quickly. We are very much focused on the capital allocation. Capital is scarce, of course. It's generated by our production. So we have to be very careful with how we allocate our capital. And one of the most important things on that is managing your costs so that we're not overspending or we're not spending on things we just absolutely don't need, because the lower our costs, the more we get to do. And that's very important for us to move forward. And that's our presentation. I'll hand it back to our moderator.
Perfect. Thank you, Jeffrey, and the wider team for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Jeffrey and team, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you and ask you to read out the questions where appropriate to do so, and I'll pick up from you at the end.
Thank you. Okay, some questions. What is the company culture and general work ethic? What are the actions leadership could introduce to pivot away from continuing operational failures? The company culture. The company culture is collegiate. We work together to try to find the best solution. We have We're a small company, but we have good people in all of our business units, and we work together to try to find the solution. So what that means in terms of culture is we have to work very closely together. When someone needs something or when someone has a question, the question goes out to the broader group, and then we convene a call to get together so that we can all talk about it. In a practical sense, I think that's best demonstrated by when we were building the Moftino gas plant, and we'd actually seconded people from Tunisia who had more facilities experience. They're managing the facilities in Tunisia. So we had them seconded to Romania to work on that gas plant. So the company culture is collegiate. The general work ethic, I think Alexandra and Hytham, who run both of the business units, work very, very hard. We actually have an issue trying to get them to take their vacation time. They are very, very proud of their businesses and working very hard to make them succeed. So the work ethic is very, very good, and the quality of people for a small company, I think, is we're proud to have the people we have. What are the actions leadership could introduce to pivot away from the continued operational failures? Well, I object to that. We built a gas plant and drilled 4 successful wells in a row. We managed to put an artificial lift program into Schwesh and increase our pump life from 8 months to almost 3 years. These are operational successes. Operational failures. Well, we drilled 2 exploration wells in Romania. Both of those found the gas that they were looking for. However, it wasn't in sufficient volumes to be commercial. So for exploration wells, yeah, they didn't give us commercial gas, and we're very, very disappointed by that. And so what have we done to try to pivot away from that? Well, we immediately engaged geophysical consultants, geophysical consultants to do a block-wide review, and we talked a lot about that block-wide review. And that was done to make sure that we had validated our internal views of what was going on. And in some cases, it very much validated our views. And in some cases, it created some interesting new views. So that's what we did there. In Tunisia, with the 2 workovers, the N2 well, this is a successful workover that is still waiting to be dewatered. And the reason we're not being able to dewater it is working with a partner where we're constrained by that partner. I think if it was just up to us, we would have had solvent in that well and acidized that well. The rig probably would have still been there while we did it. So unfortunately, a successful workover has now been delayed by the capital plans of a government oil company that is our partner. What can we do on that? Well, we worked very closely with them, and we try to technically show them how the other wells reacted and how dewatering moves the oil into the matrix and then into the fractures, and we've worked very hard with them on that. So that is something we continue to work on. The sidetrack, well, I think anyone who's on this call knows that we ran into a very, very undocumented and poorly maintained well. These are old wells, and going into old wells, we'd always like to be able to drill a new well, but the cost difference is about 5 times. And so in terms of capital allocation, going into the old well, we had a very good view of success, and then we found out that there were things that were not on well reports. The most prudent thing to do at that point was to stop. We could have tried to mill through all of that stuff. There was no certainty we could get through it, and we could have spent a lot of money milling through and trying to get there. The more prudent thing to do was stop, design the sidetrack, and come back to that. So that is still a valid operational well, and that's still something we're pursuing. And getting that sidetrack done is right now the #1 top of our list. So that's the things we're doing. What could we have done to identify the condition of the well before we went into it? There's very little we could have done. So these are, like I say, these are old wells, and sometimes you can run into difficulties in old wells, which we did. We are assuming 15-year extensions will be granted on Sabria and Schwesh Asada, despite not getting any extension on it at Schwesh. What gives you the confidence to book these as reserves? Well, firstly, Schwesh is very different. Sabria, given that we have a partner who continues to want to produce, and that's the government partner. We continue to book those as reserves because we have a high level of confidence that will be the case. Schweiz-Society, we've shown the government that we can increase production there and continue to increase production. There's no reason why that shouldn't be granted. Eschweiz was one well producing down a long flow line. I do not understand why a simple signature on a piece of paper to allow the government to continue to collect tax and royalties on that well. It's a 100 barrel a day well. We don't understand, but the communication at the government level for that particular extension, there's no one who really wants to make a decision is the real problem there, and that's a function of what we have to deal with in Tunisia. I talked about having Hytham run that Tunisian business unit. He's done a very, very good job of engaging conversations, and those conversations continue, but we haven't got that extension yet. No one else can produce that well. It goes through a flow line into our facility. So essentially the government's sitting with a well that they could have producing, not producing for no reason at all. But I think there's a big difference between the two bigger fields in that they do attract attention and they do attract significant tax and royalties for the government. And that we are confident, and our reserve engineer, who reviews that as well, is confident that we can still book those as reserves. Since the share price is so appalling and undervalued, have considered just selling off the assets and returning capital to investors. I can't see any catalyst for improving the share price. Can you? Well, yes, I can see catalysts for improving the share price. We have these are solid assets, and applying capital to them will generate returns, and that's how you build share prices. The pace of that is determined by the generation of our operating cash flow. So it's not as fast as we like. I'm terribly impatient. I'd love to get going. I'd love to do some exploration in Romania. I think if you remember, Moftino cost us about $15 million for the gas plant and the wells and the tie-in, and returned, it's closing in on $100 million of revenue and $40 million of operating cash flow. These are excellent investments. So returning value to shareholders, I think selling off, an old facility in Tunisia will get us next to nothing, and a gas plant in Romania, well, we can definitely use that better than selling it off. So no, I do see catalysts for improving share price. I always have, and we've had successes that we think should have been recognized. We'll continue to work that way. So we are not considering selling off the assets and returning capital to shareholders. How long has N2 been dewatering? What's the typical expected time to dewater? Well, it's been dewatering since we did the workover last year. The issue here and the question about how long, well, if we can increase that flow sufficiently, it can be fairly quick. The problem is we have right now, the water is coming out at about the same pace that the water is coming in from the aquifer. And so we're on a bit of a treadmill. What you have to do is remove the water fast enough that the oil from the matrix expands into the fractures, and then you start flowing the oil. And if you don't get that dewatering fast enough, now the issue with the dewatering is we've got old mud and we've got old drilling mud in the perforations that we need to clean out. And putting solvent in to clean that out, and then putting acid in to expand the perforation zones is something that would be done it's very, very commonly done. And so this is the frustration that we can't put a time on it, because until we can get some of these means of increasing the removal of water, we're just on a treadmill. I think we're having a little bit of progress, but it's just not fast enough. When do you expect the results of the onshore Angolan negotiation? Would it start generating revenues if successful? We've announced in these results that we have withdrawn from the Angolan onshore bid. We were selected as preferred bidder. We could not get acceptable commercial terms with the authorities there. Commercial terms range anywhere from inability to do due diligence on partners that we were partnered with, to fiscal terms, to a whole bunch of things. We do not. Others, this should have been announced by the Angolan government. It hasn't, so I suspect everyone else there is having the same sort of problems. What we found with this bidding round was it was procedurally very efficient, but once you got down to talking the details, it was very difficult and very bureaucratic to get through. Given that we have good solid assets, given that we're focused on the sidetrack, we couldn't spend a great deal of time, and we concluded that we weren't going to be able to get to a position that we could be comfortable with. So we have announced that we withdrew. The next question is, you announced that we withdrew. What other types of growth opportunities are you looking at? We're principally looking at our own assets. We have a lot to do on our own assets. Sabria, 445 million barrels in place with 1.6%. To look at another growth asset would have to be very attractive, and it would have to show some clear synergies with what we know how to do, is onshore working the fields. We saw that in Angola, but again, we couldn't get to the finish line there. We thought it was interesting. It was what we thought would be a low-cost entry. Then we could take a look, but it turned that we couldn't control the situation to our comfort. Does the Tunisian partner have any significant financial partners, or if not, do we have any idea whether or not they can add to their contribution? Tunisia as a state has significant financial problems. That probably means that every institution in Tunisia has similar constraints. However, we've never had any problem with ETAP paying their share. And we have approval for the sidetrack, which is a significant financial contribution from them. And we're comfortable that they pay their cash calls on time. And in fact, when we're ordering long lead items, we can actually get them to pay their cash calls in advance. So I think we all have to recognize that Tunisia as a state has significant financial problems, but we have not experienced that with ETAP and paying their cash calls. We have, I think we've seen hints of them constraining their capital like any good business would do, and they're prioritizing their capital to the task that they think will return with the lowest risk return. Is there any indication to their time frame? Well, their time frame on the sidetrack is exactly the same as ours. It's not just capital, I think, on N2. It is a difference of opinion on what we should do with this well. And, that's just something we have to work through technically with them, and it takes time. What funding strategies are in place for upcoming exploration and development projects? I've said that we try to fund our capital through our operating cash flow. There are currently no plans to raise equity or debt, but very early on in my career, I was told never to say never. Things can happen. Things can change, but we have no current plans to raise any further capital. We will develop this business on the operating cash flow that we are generating. The AGM director re-election results show a significant selection of shareholders who frustrated the board of directors. What plans are underway to improve this relationship? Well, firstly, this AGM was very frustrating because two of our major shareholders were unable to get their votes recognized by Computershare. 9% of our shareholders voted, with a significant portion of our major shareholders unable, through various complications with their nominees, to get their votes recognized. We were talking through Computershare to the nominees up until the vote, trying to get these votes recognized. And that would have been a significant difference in the votes. So I think you're not seeing a representation of where our institutional and our big shareholders are at. But I recognize that there are people that are frustrated with our board of directors. We've always been open. At the back of every presentation are contact numbers. We're always open. My chairman is open to having conversations with people. If people want to discuss this, we'd be happy to chat with them. We are a very open and accessible company. And so if people want to talk to us, we'd be eager to chat. And the numbers and the email addresses, we are info@serinusenergy.com. Calvin and I try to respond to everything that comes into that. If you want to send something in that threatens the life of my children, you probably shouldn't expect a response. But every time that we've had shareholders contact us through that, either Calvin or I will get directly back in contact with you as quickly as we can.
That's great, Jeffrey. Thank you and the rest of the team for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before I redirect investors to provide you with their feedback, which I know is particularly important to the company, Jeffrey, could I please ask you for a few closing comments?
Yes. Well, look, thank you everyone for attending. It's important that we have this opportunity to communicate our thoughts and where we're at with progress. I think we're all frustrated that we can't move faster. There are investments out there that we would love to pursue. We have a very, very solid set of assets. I think that is demonstrated through the cash generation and the stability now. And we have great opportunities. You know, we keep talking about what Moftino did for this company. We would love to do that again. Look, I think, you know, there's good quality assets. There's a technical plan that's not just generated by us and myopically stuck to. We test that always with third parties to validate our thinking. So we're not working in an echo chamber. We are trying to test all of the ideas as thoroughly as possible. And the opportunity set is really quite attractive. We try to demonstrate that opportunity set by having third parties like our reserve engineers validate what assets we have. And those reserve reports consistently show the size of the assets and the size of the price. So it's up to us to manage the capital and get the most bang up for our buck on every dollar of capital we spend. Generate the capital, apply it, and build returns. But again, thank you for attending. We do appreciate the time to talk to people and answer questions, and we're always available if people want to reach out to us. Thank you.
Perfect. Jeffrey, thank you and the team once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you for attending today's presentation, and good morning to you all.